You know, most people think staying safe means keeping your money where you can see it. Savings accounts, local real estate, maybe a 9-to-5 job. These feel secure, right? But here's the thing. In the world of the ultra-wealthy, what looks like a safe move is often the fastest way to lose it all to inflation and taxes. Think about it. Your savings account is earning what, maybe 0.5% interest. Meanwhile, inflation is running at 3 to 4% per year. You're not preserving wealth. You're watching it evaporate in slow motion. The wealthy understand something most people don't. True financial security doesn't come from playing it safe. It comes from building structures that protect your wealth from the real threats. Market crashes, lawsuits, tax erosion, and yes, even your own bad decisions. In this video, we're breaking down the 7 moves that terrify the middle class, but are the foundational safety nets for billionaires. These strategies might make your financial advisor nervous, but they're exactly how generational wealth is built and protected. Let's start with something that sounds absolutely insane to most people. Taking on multi-million-dollar loans when you already have the cash to buy whatever you want. The risky look. Imagine you've got $10 million sitting in your account. Most people would use that cash to buy their dream home, maybe a vacation property, perhaps a yacht. Zero debt, complete ownership. That's the dream, right? But the ultra-wealthy, they'd never do that. This is what the wealthy call using low-interest debt to avoid liquidation events. Here's how it works. Instead of selling your assets to buy that $5 million home, which would trigger massive capital gains taxes, you borrow against them at 2 to 3% interest. Let's break down the math. If you sell $5 million in stock to buy a house, you might pay $1 million in capital gains taxes right off the bat. Gone. Vanished. But if you take out a $5 million loan at 3% interest, you're paying $150,000 a year in interest, which is often tax deductible. Meanwhile, your $5 million in stocks continues growing at, let's say, 8% per year. That's $400,000 in gains annually. Think of it as a financial buffer. Instead of killing the goose that lays golden eggs by selling your appreciating assets, you borrow against them. The asset keeps growing, the debt is cheap, and you avoid the tax trap. It's not reckless borrowing, it's strategic leverage. Here's the key. The interest rate on your debt must be lower than the return on your assets. As long as that equation holds, you're making money by staying in debt. Now let's talk about something that goes against everything you've been taught about investing. Putting all your eggs in one basket. Most financial advisors will tell you to diversify. Spread your money across stocks, bonds, real estate, maybe some international investments. Don't concentrate too much in any one area. But look at the truly wealthy, and you'll see something very different. Diversification is protection against ignorance. The wealthy don't diversify their way to riches. They build productive assets they actually control and understand deeply. Think about it. Jeff Bezos didn't get wealthy by owning a little bit of everything. He owned a massive concentration of Amazon stock. Elon Musk? Tesla and SpaceX. Warren Buffett? Concentrated positions in businesses he understands completely. Here's what's really happening. When you diversify too much, you're basically admitting you don't know what you're doing. You're hoping that if you spread your money thin enough, something will work out. The wealthy take the opposite approach. They develop deep expertise in 1 or 2 areas, then go all in. Think of the bakery owner versus the pastry chef. The chef has a safe salary working for someone else, no risk. But the bakery owner? They've invested everything into their business. It looks risky. What if the bakery fails? But the owner has the upside potential. They control the business. They understand every aspect of it. And if it succeeds, the rewards are unlimited. The chef gets predictability. The owner gets wealth. The key distinction. The wealthy aren't gambling on things they don't understand. They're concentrating on assets they control, businesses they've built, or industries where they have genuine expertise. Here's one that really freaks people out. Intentionally locking your money away where you can't touch it. Putting millions into assets you can't sell for 10 or more years. Private equity funds with 7-year lockups. Large land purchases in developing areas. Investments in startups that might not go public for a decade. Most people want liquidity. They want to be able to access their money at any moment. It feels safe to have everything liquid. But is it really? This is what the wealthy call the permanent vault. It's not about locking money away randomly. It's about protecting wealth from 2 threats: human nature and bad decisions. Here's the truth that nobody wants to admit. We are our own worst enemies when it comes to money. When the market crashes 30%, what do most investors do? They panic and sell at the bottom. When they see a shiny new investment opportunity, they chase it without proper due diligence. By making certain assets illiquid, you're protecting yourself from yourself. Think about the 2008 financial crisis. People who had money locked up in 10-year private equity funds or land holdings couldn't panic sell. They had to ride it out. And guess what? By 2015, those assets had often doubled or tripled from their 2008 lows. If you can't touch it, you can't spend it on ego projects or liquidate it during a market panic. Illiquidity is a feature, not a bug. The wealthy use this strategically. They keep enough liquid assets for lifestyle and opportunities, but they lock away the wealth preservation bucket where their emotions can't touch it. This one sounds absolutely crazy. Moving capital into foreign markets or offshore structures. The risky look. Moving money into foreign markets, setting up accounts in Switzerland, Singapore, or the Cayman Islands. Investing in emerging markets. To most people, this screams risk. What about political instability, currency fluctuations, foreign regulations? This is jurisdictional diversification, and it's a protection parking spot for when the world feels unstable. Here's what the wealthy understand. Having all your wealth in one country is actually the risky move. What if your home country passes wealth taxes? What if there's a currency crisis? What if the political situation changes dramatically? By having assets in multiple jurisdictions, you're not putting all your faith in one government's policies or one currency's stability. It protects against lawsuits and political pressure in your home country. If someone sues you in the United States, assets held in certain foreign structures can be much harder to access. If your home country's currency weakens, you have holdings in stronger currencies. This isn't about hiding money or tax evasion. It's about not having all your eggs in one governmental basket. The ultra-wealthy learned this lesson through history. Governments change, policies shift, and currencies fluctuate. Geographic diversification is just as important as investment diversification. Now let's talk about something that seems wasteful to most people. Spending $500,000 or more per year on a chief of staff, specialized tax lawyers, family office managers, or a full advisory team when you could do it yourself. Most people look at these expenses and think, that's insane. I could save that money and do my own taxes, manage my own schedule, research my own investments. This is buying back time. And at a certain wealth level, your income has a limit because your body has a limit. Let's do the math. If you're a high-earning professional, doctor, lawyer, consultant, you might earn $200 to $500 per hour for your time. That sounds great, right? Except there's a ceiling. You only have so many hours in a day. But what if, instead of spending 10 hours a week managing your investments, reviewing contracts, and optimizing your tax strategy, you paid someone $100,000 a year to do it better than you could? That frees up 500 hours annually. If you use even half that time to grow your business or make strategic decisions, you've more than paid for that person, the system owner. You aren't paying a salary, you're buying a machine that runs while you sleep. Think of it this way. A specialized tax attorney might save you $300,000 in taxes through strategies you didn't even know existed. They cost $150,000 per year. That's not an expense. That's a 100% return on investment in year one, and it compounds every year after. The wealthy understand that expertise is leverage. The right advisor can open doors, prevent disasters, and create opportunities worth millions. This is a move that makes people's financial advisors very nervous, moving out of guaranteed bank savings into money market funds, treasury bills, or other vehicles during uncertain times. Your parents probably taught you, keep your money in an FDIC-insured bank account. It's safe, it's guaranteed, the government backs it. Moving money out of that safety net seems risky, right? This is liquidity parking, and here's the uncomfortable truth. Banks are actually riskier than you think, because they pay unacceptable rates that don't cover inflation. Let's break this down. Your bank savings account pays maybe 0.5% interest. Inflation is running at 3 to 4%. You're losing 2.5 to 3.5% of purchasing power every year. That's not safety, that's guaranteed loss. Meanwhile, a money market fund or treasury bills might pay 4 to 5% with virtually the same safety profile. US Treasuries are backed by the full faith and credit of the US government, literally the safest investment on earth. Use the safest kid in school analogy. US Treasury securities are like the safest kid in the school. Sure, banks are FDIC insured up to $250,000, but for larger amounts, you're actually taking on bank-specific risk. During the 2023 banking crisis, we saw multiple banks fail because they made bad investment decisions. Their depositors were fine up to the FDIC limit, but anything above that was at risk. Meanwhile, people holding treasury bills had zero concerns. The wealthy park their liquid cash in instruments that actually preserve purchasing power while maintaining safety. They're not chasing yield. They're simply refusing to accept negative real returns. This final one is perhaps the most counterintuitive of all. Putting your house, cars and businesses in the name of a trust or foundation instead of owning them personally. This freaks people out. You mean I don't actually own my own house? My name isn't on the title. That sounds crazy. Control without ownership. Here's what the wealthy understand. Ownership makes you a target. If your name is on everything, you're personally liable for lawsuits. In a divorce, those assets are on the table. If someone wants to sue you, they can see exactly what you own and come after it. But if you control assets through properly structured trusts or entities, you get all the benefits. You live in the house, you drive the car, you run the business, without the target on your back. If you don't own it, nobody can take it from you in a messy divorce or lawsuit. You still get the benefits without the vulnerability. Think about it this way. A properly structured trust means that even if someone successfully sues you personally, the assets in the trust are protected because they're not technically yours. You're just the beneficiary or the controller. This is how generational wealth works. The Rockefellers, the Kennedys, they don't personally own most of their assets. Everything is in trusts and foundations that provide benefits to family members while protecting the wealth from individual mistakes, lawsuits, or poor decisions. So there you have it. 7 wealth moves that terrify the middle class, but a standard operating procedure for the ultra-wealthy. Here's the key takeaway. Wealth isn't about what you earn. It's about the structures you build to protect it from human nature, both your own impulses and external threats. These strategies aren't reckless. They're the opposite. They're calculated moves designed to protect wealth from the real risks: inflation, taxation, litigation, and bad timing. The middle class focuses on accumulation, the wealthy focus on protection and structure. Which of these moves felt the most risky to you? Drop it in the comments. And if you're ready to move from basic financial literacy to actual wealth building, subscribe to Daytime Luxe. We'll see you in the next one. Your first step isn't implementing all 7 strategies tomorrow, it's education. Start by understanding which of these applies to your current situation. Whether it's talking to a tax advisor about strategic debt, exploring asset protection through trusts, or simply moving your cash from a 0.5% savings account to treasury bills at 5%. Small structural changes compound over time. The wealthy didn't build their fortunes overnight, but they did build them intentionally. And now you know how. See you in the next video.